Hello, everybody, and welcome to Styles of Trading Part 1. This is a complete overview of all the styles of trading brought to you by Dash Trader. My name is Michael DeJoy. I'm a native New Yorker. I grew up here in New York's financial community and traded the internet tech bubble, its inflation, its later deflation, the financial crisis, the 13-year rally that subsequently followed. I've had pretty much every role you could imagine on a professional trading desk. I started off as an individual trader, became a desk trader, risk manager, later a market maker and trading desk manager, went back to individual trading, as well as have been a fund manager for various different asset classes, from cryptocurrencies to equities and options, as well as foreign currencies. With all of that, I acquired all of my securities licenses, my Series 7, 63, 55, 24, and now I am an educator here for Dash Trader. I've taught people all over the world for a leading international education company, and then I started my own in 2005. And so with that wealth of experience, I bring to you the styles of trading that I have used over the course of my 23-year trading career. And let's just jump right into the content. And I'm going to tell you a little bit about the different styles of trading. And the first one that I want to talk about is the one of the most interesting, because it's a hybrid style of trading. It's called position trading. You are a techno-fundamental trader, meaning that you have a position in a particular stock, asset class, or sector, and you took the position because you like something about it from a fundamental perspective. Also, you are taking that position because the technicals line up and agree with taking that position in that particular asset class, stock, or sector. The setup is usually based on the monthly. The trend is also, so you're looking at your trends, you're looking at the trend on the monthly chart as well. And or you're looking for a trend, a sideways trend, because you think it's going to break out on the monthly. Then once the actual setup starts, the pattern, and I'm going to use this term a lot, the pattern is the gateway to the trend. So a lot of times the trend is as we very often will say, is that the trend is your friend. The trend is very, very important. It's more important actually than the pattern, but you need the pattern to get a refined entry. And then you need a even more refined entry by taking a trigger that agrees with the pattern, that agrees with the trend. Subsequently, that brings us to the next trading style. So let's just review a little bit. Position trading is a monthly style of trading. You're looking to take long-term trends that agree with techno-fundamental reasons for getting into that sector, asset class, or stock. Core trading is purely technical. Now, could you have some fundamental reasons that you like it as well? Absolutely. If that's complementary, it's a long enough style of trading that you look and you do your analysis on the monthly chart, and then you drill down and look for a weekly trend. The weekly trend, you look at your weekly chart, you look at the direction of the moving averages, you look if you're trading a breakout, you think that the breakout will be to the upside. And then you're using your daily to kind of enter that weekly trend, okay? And the trigger is also on the daily because you're not trading the small moves. Now, with that being said, the current market condition, we've been up for 13 years, right? So if you took position trades in 2009, 2010, you'd probably be unwinding some of those position trades if you were concerned with the current market, inflation of assets, et cetera. So realize that depending on where you got in, where you took your initial position, and remember, institutions tend to position trade and core trade. As the uptrends, in this case, our current uptrend has been going on for 13 years, you start to go and reduce your time frame for your trades. So let's say you joined the uptrend in 2017, 2016, 2018. Then you might have joined that as a core trade, right? So the core trend would have been up, and therefore you're trading the weekly trend up, and you got in on one of those entries. Now you've been up for a very, very long time. you are concerned that the uptrend may be mature, inflation is coming in, and yes, the uptrend can most certainly continue, right? Because there's a situation going on right now. We call it NOLA, no other logical alternative, right? So as inflation exceeds 3%, 4%, what you see is that you have to put your money into investments like equities because you're concerned that your money is going to sit fallow and you're going to lose money in relation to inflation by not investing your money. So sometimes what happens is that, yes, inflation will trigger the end of a market, maybe volatility, but it will also spike the market up and increase the trajectory of the trend very, very close to the end. And again, that's why you might go and drop down from position trading if you started trading in 2009, 2010, 2011 to core trading if you got in 2015, 2016, 2017, 2018, and now 2020, 2021, swing trading was the order of the day. You don't know if the trend is going to end because it's very mature, but you don't want to miss out on those swings. So you trade using your weekly charts to identify the setup. You're using your daily trend to kind of manage your trade. And of course, if you're getting an entry, pattern is the gateway to the trend, your daily chart, or if you're trading with low capital and you're just starting out and you need to have really, really refined entries, you use your 15-minute, your 30-minute, your 60-minute, or sometimes even your daily, because if you use your daily, the distance between your entry and your stop is going to be a little wider, but you can just reduce your position size. And that's something that I'm going to cover in one of my upcoming series, which is going to be a series on risk management. But certainly certainly you can check out the swing trading lesson that will give you a little bit more insights into risk management as well. So certainly stay tuned for some of our upcoming videos. Of course, you need to subscribe and get alerts. Just click the little alert button when there's a new video and we'll notify you when the next video is out. This series is an 8-part series. So we are literally going to be covering all of these different styles of trading in more detail. We'll do a deep dive into each of them. We'll give you some examples as well. So let's drop down and say, okay, so the market's getting in at the beginning of a breakout or during a long trend. You can do position trading with some fundamental reasons to back you up. I'll give you an example of why position trading had some fundamental reasons, right? QE1, QE2, QE infinity. Infinity and beyond, QE infinity and beyond during the pandemic. Certainly you got core trading, right? Core trading is just that your charts are in a weekly uptrend. Things that were in a great core trend up have been semiconductors, right? Semiconductors are needed in everything. So that was a great core trading sector. Certainly technology all during the pandemic was a great core trading sector. Swing trading, right? You got daily swings on all different stocks, all different reasons why you get daily swings. And then, of course, as volatility increases, and why does volatility increase? Inflation, okay? Uncertainty, okay? Inflation brings uncertainty because, yes, you know that you have to put your money in the market, but of course, at any time, the Fed can say enough is enough with inflation, and now we start to have to increase interest rates to keep pace with the rate of inflation. If inflation is not a short-term specter, as certainly the Fed and others in the Treasury have indicated they believe it is, then certainly it will lead to higher interest rates. And when you get a situation where you might get interest rates increased, or everybody's watching all the economic numbers like the CPI and the CCI, then you're going to see that you'll get a lot more volatility. Volatility creates opportunities for intraday trading, and intraday trading uses the daily for setup, the trend, the 60-minute, the 15-minute trend, uses the 15 and the 5-minute pattern, uses the 5-minute, the 1-minute, and the 2-minute for the trigger. So again, gateway to the trend is the 15-minute and the 5-minute. The trend that you're using for intraday trading is generally the 15-minute and the 60-minute. So the trigger is an even smaller, more exact, more precise entry. So trigger is another word for entry. Now let's go to the final. This is the realm of the professional trader. This is momentum day trading, momentum trading and scalping. Okay. And this is the realm of the intraday or professional trader. And it could be momentum trading, which is generally done on the 5-minute trend using the 1 or the 2-minute chart and even your level 2 to confirm your entries. Scalping, there's 2 varieties of scalping, and I'm going to talk about that on the next slide. But certainly you're looking for daily support and resistance. You're looking at the 5-minute and the 1-minute for the trend, and then you're looking at your level 2 for confirmation of entry. Let's jump in and take a look a little bit more at the different intraday styles of trading. So you have relative strength trading. Now I want you just to notice, before I jump into relative strength trading, the styles of trading, the objective for the style of trading, what size of move are you going into? How big is the move that you're taking? You should know how big of a move you're taking when you take the trade. If you're just flying by the seat of your pants and you don't have a plan, that's a problem in and of itself. And that's going to be covered by one of my future videos. And certainly I can work on that with you in coaching. Next, key factors. What are some of the key factors that differentiate this style of trading from some of the other styles of trading? And then finally, commissions, right? Commissions are important, or the lack of commissions are important for the style of trading that you're doing. So you need to make sure you have a broker, and you need to know that you have technology that complements the style of trading that you're doing. So now that we know the matrix of the styles of trading, let's drill down into the actual styles themselves. So the first one I had mentioned already, which is relative strength trading. Your objective is to carry the positions while hedging, adding and taking profits. The size of the move, you're going for big or intermediate size trending moves. Key factors is selection, direction, and management. Commissions, low ticket, low cents per share, high trader payout. Next. I say high trader payout. Let me explain that for a second. So low minimum ticket routing rebates. Okay. If you're using a professional trading platform and a professional trading broker, they will pay you rebates and they will give you a low commission. If you are prop trading, there's not so much prop trading going on these days, but certainly prop trading, they give you a percentage of profit, but certainly there are a lot of professional traders that still prop trade, which they get a percentage of profit based on how good they are and a whole bunch of other varying factors. So relative strength trading requires a low commission, and usually it's better done if you have rebates. And a platform like Dash Trader, you can keep track of your order execution and your routing, and you can route effectively to a place that's going to pay you a rebate if you're adding liquidity as opposed to taking liquidity. You pay if you take, and you get paid if you add. That's the make or taker model. It's not so required for relative strength trading, but when you get down to NASDAQ rebating and scalping, it's an absolute necessity. There are also a plethora of commission-free brokers, but as you know, if something says it's free, it's not always fully free. That means they're making money from your order flow, in which case your executions may not be as good. So always take that into consideration as well. So let's jump in. So relative strength trading is kind of the longer term style of day trading. You're taking positions during the course of the day and you're going for big intraday swings, okay, on high beta stocks that have lots of movement. And the key factors here is selection of the stocks, the direction, that you get the direction right, and that you manage your trade properly. And really it's summarized in this: you pick the weeds, you water the flowers. You pick the stocks that are going up in an up day, and you keep adding to your positions as long as they're going up. Okay. Take your profit when it hits your profit target. And then obviously you try to get out of anything that's not working and you cut your losses small. So you're kind of taking positions in the direction of the trend and then getting out when it stops trending in your favor, and you're cutting those losses really relatively small. Directional day trading is low risk, high odds technical trading. Again, more volatile markets are better for day trading, or you have to trade higher beta stocks. And look, there's always a stock in the market that has volatility for one reason or another. News, some kind of earnings report, right? You always have earnings. It's going to create volatility 4 times a year. My favorite time to trade is always earnings season, right? Earnings season is the best kind of volatility because it's predictable volatility. So, you know, it's coming out, you know, the earnings are coming out two weeks in advance. So generally, so you can plan for what can happen and where it's going to be in terms of support and resistance going into that earnings announcement, right? So you got 2 weeks a run up into earnings usually, and then you get some kind of a volatile earnings event after the earnings are announced. So we're going to talk about that more when we get to gap trading and fading. But certainly directional day trading, low risk, high odds, technical opportunities to achieve your daily targets, depends on the price of the stock and the stock tactic. The setup, S plus TPTST, setup plus trend plus pattern plus trigger plus stop, timing in between. Okay, trend, pattern, trigger, stop, target, and timing in between. Okay, so just one more time: setup, trend, pattern, trigger, stop, target, timing in between. So you need to have a good commission rate, and you need to have a good payout if you're prop trading, and you need to, it's better if you get rebates, if you have a broker that allows you to get your rebates paid back into your account, because that offsets your commissions. Next, gap trading and fading. This was my personal favorite style of trading 4 times a year. It's during earnings season. We are going into, we certainly go into earnings season 4 times a year. So you have about a month and a half of volatility. Capturing gaps, gap fades, gap and goes, depends on the gap and the tactic, the gap setup and selection. So selection is just choosing which stocks that have earnings. The setup is, is it a gap and go? Is it a gap and crap? Is it a gap fade reversal, bull trap, bear trap, bull kicker, bear kicker? These are all types of gap trades. And again, that's a lesson for another day. We're going to touch upon that when we get to the individual lesson on gap trading. And then finally, this is a trading style that can be done in all market conditions, anytime. You just got to look for the opportunities. It's trading such small time frames on either NASDAQ stocks or New York Stock Exchange stocks, doing volume, collecting rebates, doing volume while making sense. The motto of this style of trading is lots of crumbs make a meal. The key factor is patience, efficiency, and discipline. Patience is because you're taking big, mainly larger size blocks of shares, waiting to get filled, sometimes requires patience. Choosing which route to route your order on requires efficiency. And then, of course, discipline is the discipline of carrying out your trading plan and being patient and being efficient. Certainly, commissions are a huge factor. The routes are a huge factor. Excellent trading software such as Trader, huge factor. Gap trading, again, huge factor is the style of the trading technology like Gap Trader, like Trader, because it's a really good mistake that I made. Trader is a great gap trader because it helps you find gapping stocks with its trade strategy feature, the market minder window, etc. So you can find these opportunity stocks that are gapping up and gapping down, risers and fallers, pre-market. So you need to have that pre-market data. So trading technology needs to complement your commissions, complement your style of trading, and that all works together. So what I wanted to do here was just to give you a great basic overview of what goes into the different styles of trading. We've talked about, I'm just going to go and recap. Trading style, position trading, core trading, swing trading, intraday trading, momentum trading, and scalping. Notice the differentiating factors are setup and the time frame of the trend. Okay, then you use a pattern as a gateway to the trend, and then you use a trigger to kind of get into the individual play. Okay, so styles of trading continue, drilling down into the intraday styles of trading. You have relative strength trading, directional day trading, and look, relative strength trading, just keep it in your mind, pick the weeds, water the flowers. Directional day trading, you're a sniper. You're waiting for a stock to get into your sights. Patience, waiting for that exact moment, pull the trigger, manage the trades. You need to be very patient. You need to scan the news, consider different opportunities, what's going on, what meme stock is hot for the day potentially. Gap trading, a lot of planning around earnings season, watching the news, seeing the markets are gapping up, gapping down, how they're gapping. And then next we have scalping. It's a very, very small time frame, small size moves. So you're not trading. So here on relative strength trading, you're trading big to intermediate size moves. Directional day trading could be intermediate to smaller moves, even bigger moves, can be any size move. Gap trading, you're looking to trade the gap. That's the size of the move, and probably gap continuation or gap reversal. And then, of course, scalping, you're trading small to at most intermediate size moves. Now that prices of stocks are higher, the size of the scalp might be bigger, 5 cents to 25 cents. If it's a low price stock, you might be scalping for 1 to 3 cents or even a penny, depending on how good your commissions are and your rates are, and if you're getting rebates or not. So just keep all of this in mind. These are the major styles of trading. And if you want to learn more and you want to work with me individually, certainly some of the next steps are for you to continue learning with me and Dash Trader. You can go to learndaytrading.com, scroll down to the featured educators section, find my picture, select which coaching session you're interested in. We have a great introductory session for 30 minutes. It's just $50. I can give you a great introductory session where you can see if I can help you refine your styles of trading, work on your trading plan. And then obviously we can agree on an hourly package, and basically you can sign up for different hourly coaching session packages. The more hours you sign up for, the bigger discount you get. Either way, I can help you work on your trading. And really what I focus on doing is really honing your trading skills so that you are more consistent, more profitable, and that you are up to tune and in tune with whatever's coming next in the market. So on that note, thank you so much for joining me, and I'll see you on the next session, and trade well, everybody.